RBI MPC meeting June 2025 live. RBI cuts repo rate by 50 bps, toughens stance to neutral, eases FY26 inflation forecast to 3.7. RBI MPC meeting June 2025 live. Updates in a widely anticipated move. The Reserve Bank of India's Monetary Policy Committee MPC cut the repo rate by 50 basis points to 5.5 on Friday, marking the third straight rate reduction this year. The MPC also shifted its policy stance from accommodative to neutral, underscoring a recalibrated approach amid evolving macroeconomic conditions. Announcing the decision, RBI Governor Sanjay Malhotra said the move follows a comprehensive assessment of the current economic landscape. The committee concluded its THREA-day meeting today, which began on June 4, 2025. This rate cut follows 25 basis point reductions in both February and April. While most market experts had expected another 25 basis point cut this time around, a research note from the State Bank of India had flagged the possibility of a more aggressive 50 basis point cut. Since February 2025, the RBI has cumulatively cut the repo rate by 50 basis points. This easing has prompted most banks to lower their repo-linked external benchmark-based lending rates EBLRs and marginal cost of funds-based lending rates MCLR, ultimately making loans cheaper for both retail and corporate borrowers. In effect, lower repo rates typically translate to lower MEs, offering a breather for households and businesses alike. Ashish Jarath, President Sales Marketing of Smart World Developers, said, the RBI's recent decision to reduce the repo rate by 50 basis points is a significant move to stimulate economic growth. This reduction lowers borrowing costs, making home loans more affordable and easing financial pressure on developers. In Delhi NCR, where demand is already picking up with a 17% increase in new residential supply in Q1 2025, this rate cut will accelerate sales and project launches. It creates the right environment for buyers and developers alike, reinforcing confidence and driving the next phase of growth. Ashwani Kumar of Pyramid Infratech said, the RBI's move to reduce the repo rate by 50 basis points is a timely and growth-oriented decision that will strengthen buyer sentiment in the real estate market. Lower interest rates will enhance home affordability, especially for first-time buyers, and ease the financial burden on developers. This policy shift is expected to accelerate housing demand and contribute positively to the sector's recovery and long-term momentum. Rajat Goel, Managing Director of MRG Group, said, we applaud RBI's move to bring repo rate to 5.5, especially at a time of economic stability. Not only will this boost housing demand among buyers, making home ownership affordable for them, but for developers, this will encourage them to bring more projects. Hence, we see this one decrease setting the stage for a better recovery in both real estate and the broader economy. Harinder Singh Hora, founder-chairman of Reach Group, said, the RBI's decision to cut the repo rate by 50 bps and bring it to 6 comes as a timely boost for the real estate sector. Lower interest rates would likely spur greater demand for retail loans, encouraging businesses to expand and boost industry consumption. Hence, we expect a significant uptick in leasing activity and new project launches, reflecting strong investor and occupier confidence. Colin Shah, MD, Kama Jewelry, on the RBI MPC announcement. RBI's decision to cut the repo rate by 50 bps to 5.5 has taken the industry by surprise. This move is encouraging and should help boost sentiment across sectors. With stability on the price, financial, and political fronts, there are growing opportunities for both domestic and foreign investors. The GDP forecast being maintained at 6.5 and inflation cooling to 3.7 from the earlier 4 for FY26 shows that India's economy is progressing well on both growth and inflation fronts. It also underscores robust consumption backed by strengthening disposable incomes. As for gold, prices remain volatile in both domestic and international markets, driven by macro headwinds. With the US Fed's decision due later this month, we must wait and watch how global gold prices evolve. As we enter the gold buying season, a softer inflation environment will strengthen purchasing power among the masses, reinforcing demand in the domestic gems and jewelry sector. Ashwani Tahanwat, Executive Director Chief Investment Officer, Shriram General Insurance. The significant 50 bps repo rate cut signals the RBI's intent to spur economic growth. This is the third consecutive rate cut by the central bank in 2025. The MPC's shift in policy stance from accommodative to neutral reflects a recalibrated approach amid evolving economic dynamics. Another major step is the 100 bps CRR cut, from 4 to 3, which aims to enhance liquidity and stimulate credit growth. These decisions come at a time when retail inflation has eased to 3.16, the lowest since July 2019, giving the RBI room to support economic momentum. Increased liquidity and a push for growth could also stimulate demand for insurance products as businesses expand and consumers have more disposable income. Amit Jain, Chairman and Managing Director, Arcade Developers. The RBI's decision to lower the repo rate by 50 bps to 5.5 is a progressive move, particularly against the backdrop of sustained economic growth and easing inflationary pressures. This rate cut brings renewed optimism for the real estate sector. Lower interest rates translate to more affordable home loans, which should boost home buying sentiment, especially in mid-income and premium housing segments. This policy move isn't just about affordability, it also signals long-term confidence in India's growth trajectory. We expect this to fuel positive sentiment among indices and investors, leading to faster inventory offloads and greater momentum in new project launches. RBI's focus on growth without compromising financial prudence strikes the right balance for the real estate sector to thrive. Nitin Bavizzi, CFO, Ajmera Realty Infra India. The RBI's decision to cut the repo rate by 50 bps to 5.5 comes at an opportune time, with inflation easing to 3.2 and remaining within the central bank's 24 target range. This is the third consecutive rate cut, underscoring the RBI's resolve to support economic expansion while ensuring price stability. Lower lending rates could make homes more affordable for many, boosting demand, especially in the mid-income and affordable housing space. We expect a significant increase in housing absorption and buyer confidence as a result. From a developer's perspective, lower interest rates and improved liquidity will enable faster project execution and relieve working capital pressures. This not only strengthens balance sheets but also creates a virtuous cycle of growth for both demand and supply, a win-win for the entire real estate ecosystem. Colin Shah, MD, Jewelry, on the RBI MPC announcement. RBI's decision to cut the repo rate by 50 bps to 5.5 has taken the industry by surprise. This move is encouraging and should help boost sentiment across sectors. With stability on the price, financial, and political fronts, there are growing opportunities for both domestic and foreign investors. The GDP forecast being maintained at 6.5 and inflation cooling to 3.7 from the earlier 4 for FY26 shows that India's economy is progressing well on both growth and inflation fronts. It also underscores robust consumption backed by strengthening disposable incomes. As for gold, prices remain volatile in both domestic and international markets, driven by macro headwinds. With the US Fed's decision due later this month, we must wait and watch how global gold prices evolve. As we enter the gold buying season, a softer inflation environment will strengthen purchasing power among the masses, reinforcing demand in the domestic gems and jewelry sector. Ashwani Tahanwat, Executive Director Chief Investment Officer, Shriram General Insurance. The significant 50 bps repo rate cut signals the RBI's intent to spur economic growth. This is the third consecutive rate cut by the central bank in 2025. The MPC's shift in policy stance from accommodative to neutral reflects a recalibrated approach amid evolving economic dynamics. Another major step is the 100 bps CRR cut, from 4 to 3, which aims to enhance liquidity and stimulate credit growth. These decisions come at a time when retail inflation has eased to 3.16, the lowest since July 2019, giving the RBI room to support economic momentum. Increased liquidity and a push for growth could also stimulate demand for insurance products as businesses expand and consumers have more disposable income. Amit Jain, Chairman and Managing Director, Arcade Developers. The RBI's decision to lower the repo rate by 50 bps to 5.5 is a progressive move, particularly against the backdrop of sustained economic growth and easing inflationary pressures. This rate cut brings renewed optimism for the real estate sector. Lower interest rates translate to more affordable home loans, which should boost home buying sentiment, especially in mid-income and premium housing segments. This policy move isn't just about affordability, it also signals long-term confidence in India's growth trajectory. We expect this to fuel positive sentiment among indices and investors, leading to faster inventory offloads and greater momentum in new project launches. RBI's focus on growth without compromising financial prudence strikes the right balance for the real estate sector to thrive. Nitin Bavizzi, CFO, Ajmera Realty Infra India. The RBI's decision to cut the repo rate by 50 bps to 5.5 comes at an opportune time, with inflation easing to 3.2 and remaining within the central bank's 24 target range. This is the third consecutive rate cut, underscoring the RBI's resolve to support economic expansion while ensuring price stability. Lower lending rates could make homes more affordable for many, boosting demand, especially in the mid-income and affordable housing space. We expect a significant increase in housing absorption and buyer confidence as a result. From a developer's perspective, lower interest rates and improved liquidity will enable faster project execution and relieve working capital pressures. This not only strengthens balance sheets but also creates a virtuous cycle of growth for both demand and supply, a win-win for the entire real estate ecosystem. Atul Manga, CEO co-founder, Basic Home Loan. The RBI's bold decision to cut the repo rate by 50 bps to 5.5 is a welcome move that signals a strong intent to boost liquidity and support growth. Additionally, the 100 bps cut in the cash reserve ratio to 3 aims to infuse higher liquidity into the banking industry. These measures are intended to stimulate economic growth amid subdued inflation and global uncertainties. While the lower borrowing costs will benefit both consumers and businesses, the CRR cut provides banks with more room to lend. The shift from an accommodative stance to neutral signals a cautious approach going forward. The markets have responded positively to the latest rate cut, with rate-sensitive sectors like real estate, banking, and financial services leading the gains. This reflects investor optimism regarding the likelihood of increased economic activity. This move brings further relief to homebuyers looking to avail loans. Those who were hesitant about taking loans may now feel more confident in pursuing home ownership. On the other hand, existing borrowers, especially those with float-in-rate loans linked to the repo rate, can expect lower MPCs. Public sector banks, which usually act faster in passing on such cuts, are expected to roll out attractive loan offerings. This will create significant savings for borrowers. That said, I would advise borrowers to review and compare loan options carefully to make the most of the favorable rate environment. RBI Governor Sanjay Malhotra: liquidity in the system is currently abundant. If we conduct any VRRR operations, the rate will remain at 5.0. However, if we opt for VSRR variable rate standing reverse repo or other modes, we have the flexibility to adjust the rate accordingly. At this point, we haven't made a decision and it will depend on how the liquidity situation evolves, and we'll take a call as needed. Gold loan stocks saw significant buying on Friday, June 6 following an announcement by RBI Governor Sanjay Malhotra, stating that the loan-to-value LTV ratio for gold loans under Rs 2.5 lakh increasing to 85% from the previous 75%, providing NBFCs with more lending flexibility. This development spurred a surge in the stocks of gold financing companies such as Muthoot Finance, Manappuram Finance, and IIFL Finance, with their shares rising between 2 to 7%. Gold finance stocks were buzzing in trade on June 6 after RBI Governor Sanjay Malhotra stated that the loan-to-value for gold loans below Rs 2.5 lakh is set to be revised to 85% from 75%, giving NBFCs greater lending flexibility. This led to sharp buying in gold financiers like Muthoot Finance, Manappuram Finance, and IIFL Finance, with their stocks rising between 2 to 7%. DK Srivastava, Chief Policy Advisor, EY India: India's GDP growth has performed admirably well in the post-COVID years. It has averaged 7.8 over the period 202,223 to 202,425. This is in spite of a challenging global economic environment where global GDP growth has been limited to 3.5. Over this period, the contribution of net exports to India's GDP growth has been 0.2 points, 2.8 points, and 2.3 points, respectively. Clearly, India's growth has been largely driven by domestic demand. Within domestic demand, it is mainly the government's capital expenditure which has been driving India's growth. A more balanced profile of growth drivers would call for a tangible pickup in private investment demand and external demand. While much cannot be said about the way external demand might evolve, domestic private investment demand can be stimulated. In this context, monetary policy is of considerable importance since it affects cost of capital. The RBI, in its monetary policy review held on June 6, 2025, lowered the policy rate by 50 basis points to 5.5 with the objective of supporting growth. It projected real GDP growth at 6.5 in 202,526 driven by private consumption and fixed capital formation. The RBI, however, changed its policy stance to neutral from accommodative. The front-loading of policy rate reduction is welcome. However, given the likely global growth slowdown and trade-related uncertainties, the RBI may carry forward the momentum of the present interest rate reduction cycle at least until the policy rate reaches 5. Conditions are ripe for maintaining this downward thrust since CPI inflation remains below the RBI's target of 4. In fact, the RBI has revised downwards its CPI inflation forecast for 202,526 to 3.7 from 4.0 projected in April 2025. As private investment keeps improving, the ongoing rate reduction cycle could incentivize private investment and take India's potential growth closer to 7 in the next few years. RBI MPC meeting live. Inducent Bank has taken enough steps to improve accounting practices, says RBI Governor Sanjay Malhotra. The bank issue should settle down very soon. No systemic impact arising out of the issue, says Malhotra. We'll keep monitoring the banking system. RBI Governor Sanjay Malhotra. There was nothing new in the draft norms on gold loans. We have consolidated all other norms. We have seen some regulated entities were not following the norms because there was no clarity, hence we have consolidated it. We will today or by Monday morning release the final guidelines. Our policy is clear and consistent. We do not manage any band, target on currency exchange rate. We let the market to determine prices, said RBI Governor. RBI Governor Sanjay Malhotra. Liquidity in the system is currently abundant. If we conduct any VRRR operations, the rate will remain at 5.0. However, if we opt for VSRR variable rate standing reverse repo or other modes, we have the flexibility to adjust the rate accordingly. At this point, we haven't made a decision and it will depend on how the liquidity situation evolves, and we'll take a call as needed. The benchmark equity indices staged a sharp rebound on Friday, with the Sensex surging over 1,000 points from its intraday low and the Nifty trading above the 24,900 mark, after the Reserve Bank of India RBI delivered a higher-than-expected 50 basis points repo rate cut and announced liquidity-boosting measures. Madhavi Arora, Chief Economist, MK Global. The RBI appears to have front-loaded all policy actions, be it higher-than-expected rate cuts or infusing durable albeit staggered liquidity via lower CRRs. All of that now implies that the ball is in the bank's court to transmit easier financial conditions faster. Anujay Puri, Chairman Anaric Group. The reduction in the cash reserve ratio CRR will help boost liquidity in the banking system, which means that banks have more funds to lend. Developers will be able to access more capital for their projects, and this can positively impact project completion timelines. It also gives banks the option to reduce home loan interest rates, which will have again positively impact sentiment in the affordable and mid-income segments. Nevertheless, these positive impacts may be partially dampened by the ongoing global trade tensions and tariffs imposed by the Trump administration, which have increased the cost of imported construction materials and created economic uncertainty. We may see some impact on the demand for luxury and commercial projects, and developer margins may be squeezed. While the rate cut is a strong positive for real estate, especially for affordable housing, much now depends on how well it can adapt to higher input costs and ongoing global uncertainties. Continued policy support and a shift to domestic sourcing could be critical for sustained growth. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target, with signs of a broad-based moderation. The near-term and medium-term outlook now gives us the confidence of not only a durable alignment of headline inflation with the target of 4% as exuded Indiana the last meeting, but also the belief that during the year, it is likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is expected to remain benign with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook for the year is being revised downwards from the earlier forecast of 4.0% to 3.7% CENT growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty. Thus, it is imperative to continue to stimulate domestic private consumption and investment through policy levers to step up the growth momentum. This changed growth inflation dynamics calls for not only continuing with the policy easing but also front-loading the rate cuts to support growth. Accordingly, the MPC voted to reduce the policy repo rate by 50 bps to 5.50 per CENT. Dr. Nagesh Kumar, Professor Ram Singh, Dr. Rajiv Ranjan, Dr. Poonam Gupta and Shri Sanjay Malhotra, voted to decrease the policy repo rate by 50 bps. Shri Saugata Bhattacharya voted for a 25 bps cut in repo rate. Ranan Banerjee, partner and leader, Economic Advisory, PwC India said, the MPC has delivered an unexpected outsized policy rate cut of 50 bps against a consensus expectation of a 25 bps cut. This is accompanied by a 100 bps staggered cut in CRR and a change in policy stance to neutral. The decision is likely owing to the GDP prints for Q4 of FY25 reflecting weakness in manufacturing and consumption, as well as the adverse impacts of global trade and conflict headwinds. The policy rate easing, combined with the liquidity increase for banks when system liquidity is already comfortable, is likely to add a second engine to the consumption growth flight that is anticipated to be already in flight from the income tax cuts taking effect in FY26. This is significantly positive for urban consumption, which printed weak in past quarters, and will also likely add a fillip to real estate, discretionary purchases and private capex. The Reserve Bank of India RBI has slashed the repo rate by 50 basis points in its third consecutive rate cut of the year, bringing the repo rate down to 5.5. While this move offers relief to borrowers by reducing the cost of loans, it's unwelcome news for fixed deposit FD investors, as banks have been slashing FD rates since the beginning of 2025 in response to the RBI's monetary easing. How have FD rates changed since February 2025? The RBI had already cut the repo rate by 25 basis points each in February and April 2025. In response to these successive rate cuts, banks have been quick to lower FD interest rates as well. According to a report by SBI Research, FD rates have been reduced in the range of 30-70 basis points since February 2025. Additionally, the report noted that banks have also reduced interest rates on savings accounts. Banks have already reduced interest rates on savings accounts to the floor rate of 2.70, SBI said in its report. RBI repo rate cut the repo rate by 50 basis points, reducing it to 5.50%. This will lower MEs for existing customers and make new loans more affordable. In a surprise move, the RBI's Monetary Policy Committee MPC has decided to cut the key repo rate by 50 basis points BPS to 5.5%, RBI Governor Sanjay Malhotra announced on Friday. With this, the repo rate is the lowest level in nearly 3 years. The RBI also announced a surprise reduction in CRR by a significant 100 bps to 3% in 4 tranches of 25 bps each, beginning September 2025. It is expected to infuse Rs 2.5 lakh crore into the banking system in the coming months. Samir Jajuja, founder CEO, NSE-listed data analytics firm Prop Equity. The RBI's 50 bps cut in repo rate, following the 25 bps cut each in February and April, along with 100 bps reduction in CRR, is bold, timely and progressive given India's growth momentum. This will enhance liquidity and spur credit growth as India's GDP growth rose to a 4-quarter high of 7.4 in Q4 FY25, placing India as the fastest growing major economy. With retail inflation in the comfort zone, a deep cut in rate and liquidity measure will spur consumption and accelerate India's growth. Both these measures will ensure faster transmission of rate cuts so that the new home buyers are cushioned from the impact of rising housing prices, and affordable housing segment also gets a fillip as even a slight reduction in home loan rates impacts buying decisions. According to Prop Equity, housing sales in India's top 9 cities has been witnessing a YoY decline, falling from 3 growth YoY in Q1 2024 to 20 in Q1 2025. The Prop Equity data also suggests that supply of homes in affordable and Mid-income category Rs 1 crore and below fell by 36 in last 2 years, 202,224 in top 9 cities. In contrast, the supply of homes priced Rs 1 crore and above have risen by 48 in the last 2 years. Chintan Pankmatya, founder, Switch My Loan. The 50 BPS rate cut has certainly come as a surprise, given the global macroeconomic cues and the domestic political landscape post-elections. This bold step by the RBI offers some immediate relief to consumers. We foresee a potential surge in demand for big-ticket purchase cars, personal gadgets, and homes driven by lower MPCs. The consumer durable, auto, personal loan, and home loan categories are poised for strong growth this quarter. We also anticipate increased activity in loan balance transfers as borrowers seek to capitalize on lower interest rates. Sonam Srivastava, founder and fund manager at Right Research PMS. The RBI's surprise 50 basis point rate cut underscores its strong pivot toward supporting growth, at a time when inflation is under control and global central banks are entering easing cycles. With real rates still elevated and domestic demand uneven, this move is aimed at unlocking credit growth, reviving private investment, and easing the burden on borrowers. Sectors like housing, autos, banking, and infrastructure are likely to see improved momentum as transmission picks up. It's also a positive signal for rural and small business credit, where growth has been lagging. That said, the market's muted reaction reflects a mix of caution and global crosswinds. Concerns around rupee weakness, global risk appetite, and the effectiveness of transmission may be holding back investor enthusiasm. Nonetheless, the move improves the medium-term outlook for consumption and capex. Bond markets are expected to rally, especially in the long-duration segment, and we believe this cut sets the stage for a more accommodative environment heading into the second half of the year. The Reserve Bank of India (RBI) is continuing the trend of delivering good news to home loan borrowers, especially in 2025. The RBI has decided to cut the repo rate and other policy rates by 50 basis points BPS. The latest cut in the repo rate means that the interest rate on home loans will come down, which means that MPCs or the tenure of the home loan will also come down. The central bank has also cut the cash reserve ratio CRR by 100 basis points to 3 from 4 earlier. With the CRR and repo rate cut, banks will be more comfortable in cutting home loan interest rates. The RBI has changed the monetary policy stance from accommodative to neutral in today's monetary policy meeting. This means that with a 100 BPS repo rate cut so far, the future rate cut is less certain and will largely depend on inflation and growth trends. Anil Rigo, founder fund manager at Right Horizons PMS. The Reserve Bank of India's Monetary Policy Committee MPC delivered a front-loaded 50 basis point repo rate cut, bringing it down to 5.5, while shifting its policy stance from accommodative to neutral. This marks a key turning point in India's monetary approach, signaling a move from active easing to a more balanced, data-dependent stance amid rising global uncertainties and volatile capital flows. Global economic growth is expected to slow by 50 basis points in 2025, with trade volume growth falling to 1.7 due to persistent geopolitical tensions. Domestically, liquidity remains in surplus, and rate transmission is gaining momentum, with banks lowering savings rates to 2.70 and fixed deposit rates by 30-70 basis points since February. The RBI maintained its real GDP growth projections for FY26, expecting 6.5 in Q1, 6.7 in Q2, 6.6 in Q3, and 6.3 in Q4, reflecting confidence in sustained growth despite global headwinds. Inflation is expected to remain within the target band, supported by strong corporate and banking balance sheets and macro fundamentals. The cumulative 100 basis point rate cut since February underscores the RBI's urgency to support demand, while the shift to a neutral stance signals a more cautious, data-driven approach to balancing growth and inflation risks going forward. The Reserve Bank of India (RBI) has cut CRR cash reserve ratio by 100 BPS to 3 from 4. Indian benchmark indices Sensex and Nifty reversed early losses and moved higher on June 6 after the Reserve Bank of India (RBI) surprised markets with a larger than expected 50 basis points rate cut Indiana its June policy meeting. The move sparked broad-based buying across sectors, while India VIX eased by another 3%, reflecting improved investor confidence. RBI Governor Sanjay Malhotra stress witnessed earlier in unsecured loans and credit cards has abated. Stress in MFI persists. On inflation and growth fronts, Indian economy is progressing well, he said. Latest blogs